Now let's take up book value per share and basic earnings per share and diluted earnings per share. Now actually we have only one set of PowerPoint presentation. However, this will extend up to chapter 21 for diluted earnings per share. So I'm going to discuss the theory, and after this we will take up the problems in the classroom. So this time only the PowerPoint presentation. So we have now the objectives in the study of these different topics and chapters: to define book value per share, to determine or identify the formula in the computation of book value per share, to understand the non-cumulative, cumulative, non-participating, and participating features of a preference share, and to distinguish preference as to assets and preference as to dividends. Now, those are the objectives in the study of book value per share. Then, for the study of the basic earnings per share, to define earnings per share, to identify the proper presentation of earnings per share, to identify and determine the formula in computing basic earnings per share, and to determine the weighted average number of ordinary shares. Then for diluted earnings per share, we have to define diluted earnings per share, to identify potential ordinary shares, to distinguish dilutive from uh, anti-dilutive securities, and to identify the formula in computing diluted earnings per share in relation to convertible bonds payable, convertible preference shares, and share options or warrants. Then we have to determine diluted earnings per share where there is combination of multiple potential ordinary shares, and to apply the test for dilution of potential ordinary shares, and to identify the accounting treatment of contingent ordinary shares in earnings per share computations. So we have now the book value per share. Book value per share is the amount that would be paid on each share, assuming the entity is liquidated, and the amount available to shareholders is exactly the amount reported as shareholders' equity. So I'll repeat: book value per share is the amount that would be paid on each share, assuming the entity is liquidated, and the amount available to shareholders is exactly the amount reported as a shareholder equity. Now, the following formula is used. Book value per share is total shareholders' equity divided by the number of shares outstanding. The book value per preference share is preference shareholders' equity divided by number of preference shares outstanding. Book value per ordinary share, ordinary shareholders' equity divided by number of ordinary shares outstanding. For purposes of apportionment between the preference share and ordinary share, the following procedure should be observed. An amount equal to the par or stated value is allocated to the preference share, and ordinary share. Any balance of the shareholder's equity in excess of the par or stated value is then apportioned, taking into account the liquidation value and dividend rights of the preference shareholders. So, taking into account the liquidation value and dividend rights of the preference shareholders. Liquidation value of preference shares. The liquidation value is the amount which the preference shareholders normally receive upon the liquidation of the corporation. The liquidation value may be more than the par value. In the absence of a liquidation value, the preference shareholder shall receive an amount equal to the par or stated value. When preference shares preference as to dividends, the dividend right may be non-cumulative, cumulative, non-participating, and participating. A non-cumulative preference share is one on which the right to receive dividends is forfeited in any 1 year in which the dividends are not declared. Thus, the preference share is entitled only to current year dividends. So that is non-cumulative, meaning if there is no declaration in 1 year, then the dividends will no longer accumulate. Second, a cumulative preference share is one on which any undeclared dividends accumulate each year until paid. Thus, the cumulative preference share is entitled to all dividends in arrears. So you have to consider all dividends in arrears. A non-participating preference share is one that is entitled to receive only the dividends equal to the fixed rate. Now, if you have noticed that your preference share, beside, okay, you have the earnings rate. So that earnings rate is the fixed rate that will be given to the preference shares. Now, the fixed rate every year. Now, a participating preference share is one which is entitled to receive dividends in excess of the basic or fixed rate. So, meaning the fixed rate, if you have only non-participating, now that will give the preference shares the dividends equal to the fixed rate. However, if it is participating, the preference share, after receiving the fixed annual claim, will be entitled to receive dividends in excess of the basic or the fixed rate. Participating preference share may be fully participating with ordinary share on a pro rata basis or participating only to a certain amount or percentage. Next, we have this in chapter 19, basic earnings per share. Earnings per share is the amount attributable to every ordinary share outstanding during the period. So you take note of this, that your earnings per share would only apply to ordinary share outstanding during the period. So in other words, this does not apply to preference shares. Ordinary shares as an equity instrument that is subordinate to all other classes of equity instruments. So ordinary share is an equity instrument that is subordinate to all other classes of equity instruments. Earnings per share information pertains only to ordinary shares. The computation of earnings per share is covered by PES 33, which requires two presentations of earnings per share, namely basic earnings per share and diluted earnings per share. The presentation of earnings per share is required for entities whose ordinary share are publicly traded and entities that are in the process of issuing ordinary shares or potential ordinary shares in the public securities market. Uses of earnings per share. It is a determinant of the market price of the ordinary share, thus indicating the attractiveness of the ordinary share as an investment. It is measure of performance of management in conducting operations, and it's the basis of dividend policy of an entity. Okay, so basic earnings per share, the formula is net income divided by ordinary shares outstanding. So again, basic earnings per share applies only to ordinary shares. So for the basic earnings per share, you merely divide net income by the ordinary shares outstanding. Okay, so as we know that there are two classes of earnings per share. The other one is basic and the other one is diluted earnings per share. Now, multiple potential ordinary shares. In considering whether potential ordinary shares are diluted or anti-diluted, each issue or series of potential ordinary share shall be considered separately or individually rather than in the aggregate. In order to maximize the dilution of the basic earnings per share, each issue is considered in sequence from the most dilutive to the least dilutive. The potential ordinary shares shall be ranked based on their contribution in terms of incremental EPS, the one with the lowest incremental EPS is ranked first. Repeat, the potential ordinary shares shall be ranked based on their contribution in terms of incremental EPS, and the one with the lowest incremental EPS is ranked first. Now we have diluted earnings per share. Options and warrants. The options and warrants are dilutive if the option price or exercise price is lower than the average market price. So if the option price or exercise price is lower than the average market price, so we can say that the dilutive earnings per share or the options and warrants are dilutive if the option price or exercise price is lower than the average market price. The options and warrants are the most dilutive because options and warrants have no impact on net income. Thus, the options and warrants are ranked first in computing diluted earnings per share. Next, we have convertible preference share. The contribution of the preference share to net income is the amount of preference dividend that is avoided because of the conversion. The incremental EPS for convertible preference share is equal to the amount of annual preference divided by the number of ordinary shares into which the preference share is convertible. Now, if this incremental EPS is lower than the basic earnings per share, the convertible preference share is probably dilutive. If this incremental EPS is higher than the basic EPS, the preference share is supposed to be anti-dilutive. Next, we have convertible bonds payable. The contribution of the bonds payable to net income is the amount of interest expense that's avoided because of the conversion. The incremental EPS for the convertible bonds payable is equal to the interest expense net of tax divided by the number of ordinary shares into which the bonds payable is convertible. Okay, so the incremental EPS for the convertible bonds payable is equal to the interest expense net of tax divided by the ordinary shares into which the bonds payable is convertible. If this incremental EPS is lower than the basic EPS, the convertible bonds payable is probably dilutive. If this incremental EPS is lower than the basic EPS, the convertible bonds payable is probably dilutive. If this incremental EPS is higher than the basic EPS, convertible bonds payable is the amount or is anti-dilutive. Diluted earnings per share, diluted and anti-dilution. Dilution arises when the inclusion of the potential ordinary shares decreases the basic earnings per share or increases the basic loss per share. In this case, the potential ordinary share are anti-dilutive securities. Anti-dilution arises when the inclusion of the potential ordinary shares increases basic earnings per share or decreases basic loss per share. In this case, potential ordinary shares. Okay. In this, anti-dilution arises when the inclusion of the potential ordinary shares increases basic earnings per share or decreases basic loss per share. In this case, the potential ordinary shares are anti-dilutive and ignored in computing diluted earnings per share. Diluted earnings per share. The computation of the diluted earnings per share is based on the as-if scenario. The convertible bonds payable is converted into ordinary share. The convertible preference share is converted into ordinary share. The share options and warrants are exercised. Next, we have the convertible bonds payable. Adjustment shall be made both to the net income and to the number of ordinary shares outstanding. The net income is adjusted by adding back the interest expense on the bonds payable net of tax. Number of ordinary shares outstanding is increased by the number of ordinary shares that would have been issued upon conversion of the bonds payable. Now, the convertible preference share, the computation of diluted earnings per share also assumes that the preference share is converted into ordinary shares. Net income is not reduced anymore by the amount of preference dividend. The number of ordinary shares outstanding is increased by the number of ordinary shares that would have been issued upon conversion of the preference share. So repeat, the net income is not reduced anymore by the amount of preference dividend. Options and warrants, share options are granted to employees, enabling them to acquire ordinary shares of the entity at a specified price during a definite period of time. Share warrants are granted to shareholders, enabling them to acquire ordinary shares of the entity at a specified price during a definite period. Options and warrants have no cash shield, but they derive their strength to the extent that shareholders are enabled to acquire ordinary shares of the entity at specified price during a definite period of time. That's share warrants. Options and warrants have no cash shield, but they derive their value from the right to obtain ordinary shares at a specified price that is usually lower than the prevailing market price. They are dilutive if the exercise price of options and warrants. They are dilutive if the exercise price or option price is less than the average market price of the ordinary share. But for employee share options, the exercise price or option price shall include the value of any services to be supplied to the entity in the future under the option plan. Okay, so that's all for chapters 18, 19, 20, and 21 for the basic, for the book value per share, basic earnings per share, and the anti-dilutive or diluted earnings per share. Okay, so tomorrow we are going to continue and take up the problems beginning with chapter 18, 19, 20, and 21. Okay, so that's all. Good night, everybody.